Alex, let's talk about some of the single stocks that are causing turbulence over here in Europe. We've got the macro story, but we've also got the granular bottom-up story to factor in as well. Credit Suisse, more turbulence, fresh market turmoil. Friday, we get the CEO, the new CEO, coming out, trying to attempt to reassure investors and, to a certain extent, investors. Don't look at the share price. Worry, think more about what is happening from a sort of stability point of view. That is where our strength ultimately lies. But it backfired. The market, investors, employees didn't necessarily read it that way. But actually, did he have a point? And I think that's the question I think we need to step back and think about here. Sonali Basak joins us to try and assess what is happening here. Communication is key at these critical junctures, Sonali. Was that just bad communication, or is this a bad story underlying what we're watching here?
It's a good question, because for Credit Suisse, we know that these issues have existed, and not only existed, but exacerbating, because you're seeing them in this vicious cycle of rising funding costs as well as deteriorating revenue. The question of whether a capital raise looms near and how they really fill that gap with asset sales is still a big question. But let's talk real quickly, as you say, about what happened over the weekend, because you saw the stock fall to a record low. You are seeing ADRs now rising in the U.S. session as some of these fears are being assuaded. But I think also you look at what Boaz Weinstein just said about an hour ago on Twitter. He says the European bank sub-CDS is a good catch-all tail hedge for the myriad of problems swirling around. So you have Credit Suisse caught up in this grand macro story now, which puts it in a really difficult and interesting position compared to where you saw, for example, Deutsche Bank in 2016, where the market was really freaked out about the CDS widening and what would happen to the bank in the longer term. Now, I did ask another investor another issue. I said, you know, are you really worried? This is a longtime banking investor, about whether he's worried about Credit Suisse in the long term. What he told me is no, and I said, is that because they're a diamond of Switzerland, or because you think that they can operationally turn around this story? And he said it's the former, not the latter. They are a diamond of Switzerland. This is a massive bank, one of, you know, two, as we always talk about, that Switzerland is really worried about, that since after 2008, of course, the regulators have kept a close eye. This is not a bank that is made to fail for Switzerland. So again, their capital buffers, as the CEO was saying, the point guide that you say that he is really hitting home here is they're not in this liquidity crunch now at all. And in fact, their capital ratios are in their planned range for the year. And as Marian Halftermeyer of Bloomberg points out as well, those capital ratios are actually higher than where Deutsche Bank had them back in 2016, where we saw that really big market issue.
And that's a really good point. And I also think that the whole idea of the too big to fail is real. They don't want a repeat of Lehman and all that. Nonetheless, where is the counterparty risk? Like, if something, Credit Suisse may be around, no problem, but there may be a lot of turmoil in the meantime. Where is the contagion risk for that?
That's a great question, because you have clients on multiple sides of the equation here. And if you look at any trading client, for example, we know that many trading clients since Archegos have started to diversify their base here. They've started to move to banks with higher credit ratings, American banks, and we've seen that even float through for many, many quarters now in the trading numbers. The investment bank, which is under a big strategic question today, I think that's also interesting to see whether clients will stay or go based on worries about larger systemic issues down the road. But listen, just for Credit Suisse alone, what happens now is we already knew this would be a long turnaround story. The costs they'll have to face in the near term will make it an even longer turnaround story. And the quote that really struck me in the memo to clients, everyone was focused on the liquidity and the critical moment. The part that struck me is the metaphor the CEO uses, is that Credit Suisse is looking to rise like a phoenix that's from the ashes. And so you're looking at the CEO acknowledging to his employees that this is not an easy task by any means, but it's something he's trying to rally the troops around and is asking them to get along for the ride.